Usually when we build things, human engineering just accepts a certain margin of error.
Right, like close enough is good enough.
Yeah, exactly. Like you build a skyscraper, maybe the steel framing is off by a fraction of a millimeter or something.
Sure.
But the building still stands, It handles the wind shear perfectly and literally nobody ever notices. We basically live in a world built entirely around acceptable tolerances.
Yeah, close enough is just how the physical world operates on a macro level.
Right. But then you step into the world of advanced semiconductor manufacturing, specifically this leading edge fabrication powering this massive artificial intelligence rollout you've been watching unfold.
Oh, yeah. That is a completely different universe.
It really is. Suddenly, close enough isn't just, a minor defect. It is a catastrophic, multi-million-dollar failure.
Completely.
We're talking about an environment where a single rogue speck of dust, like something entirely invisible to the naked eye, it acts like a literal wrecking ball plowing through a microscopic city.
It is the absolute definition of zero tolerance engineering. I mean, when you are dealing with chip architectures at the 3 nanometer or, 2 nanometer scale, a single ambient particle isn't just an inconvenience.
It's a disaster.
It's like dropping a literal boulder onto a highly congested microscopic data highway. It shorts out the logic gates, it ruins the yield, and it immediately turns a $10,000 AI GPU into, a useless piece of silicon glass.
And that zero tolerance environment is exactly where we are heading today. Welcome to a Special Talk Tickers edition of our Deep Dive. You asked us to dig into the foundational layers of the AI boom, right?
Right, to look past the companies just designing the chips.
Exactly, and find the companies that actually make this physical reality possible. So today we are taking a magnifying glass, or I guess really an electron beam microscope, to KLA Corporation.
Ticker symbol KLAC.
Yep, KLAC. The mission for this deep dive is clear. We are tearing apart their Q4 2026 earnings call for the quarter ending in June 2026. We're going to cut through the Wall Street jargon, parse the underlying financials, and extract the most actionable insights for your portfolio.
Because we need to figure out exactly why KLA is positioned as this ultimate bottleneck in global technology.
Exactly. And to do that, we're going to break this down into 4 specific pillars: the headline numbers, the story behind the numbers, management's guidance, and finally, the bottom line. Are we looking at a bullish or bearish signal?
I love it. And KLA is really the perfect case study for this kind of rigorous financial and operational analysis because, rigor is their entire economic engine.
Yeah, totally.
For those of you tracking the broader semiconductor equipment space, KLA occupies a very specific, almost monopolistic niche. They are the ultimate arbiter of quality control for the global semiconductor supply chain.
But when you say quality control at this scale, we aren't talking about like a guy at the end of an assembly line with a clipboard, right?
No, not at all. Think about the manufacturing process for a state-of-the-art AI accelerator. Before that chip ever makes it into a hyperscaler's data center to train a large language model, it has to be etched onto a silicon wafer.
And that takes a while.
Oh, it takes hundreds, sometimes thousands of incredibly complex sequential chemical and lithographic steps.
Right.
And KLA provides the hyper-advanced inspection and metrology equipment that sits directly between those steps.
So they are actively watching the build.
Exactly. They design these optical and electron beam tools that identify, locate, and mathematically characterize defects on these wafers in real time. I mean, they're measuring pattern dimensions and film thicknesses that are literally only a few atoms deep.
Wow. So if a fabrication plant, a fab, makes a microscopic error early in a 2-month manufacturing cycle, KLA's hardware just catches that defect immediately.
Right. Their algorithmic software flags the excursion instantly.
And that allows the fab engineers to, just halt the line?
Halt the line, recalibrate the lithography machines, and fix the process before they ruin tens of millions of dollars of raw wafer inventory. They are basically the security guards at the atomic door.
I love that. The security guards at the atomic door. So let's jump into pillar 1, the headline numbers. Because the financial results they just posted prove exactly how lucrative that position is right now.
They really do.
If we look at the top line performance for the June quarter, KLA reported record-breaking revenue of $3.66 billion.
Which is just a massive beat.
Yeah.
For context, their midpoint guidance, the number management explicitly told analysts to model for, was $3.575 billion. So beating by nearly $100 million at that scale is no small feat.
Not at all. That $3.66 billion top line represents a 7% sequential increase from the previous quarter and a 15% year-over-year jump.
And, in the heavy industrial equipment space, achieving a 15% year-over-year growth rate on a multi-billion-dollar baseline is staggering.
It really is.
It's a very clear indicator of accelerating capital expenditure by their end customers. But, as you know, top-line revenue is kind of just the vanity metric.
Right. The real story is the bottom line. KLA reported non-GAAP EPS of $1.05, with GAAP EPS sitting right alongside it at $1.04.
And both of those profitability metrics hit the absolute upper limit of management's guidance range.
Which tells me their internal cost controls are totally dialed in. They aren't just shipping more metal boxes, they are extracting maximum margin out of every single unit.
Exactly.
Now, for anyone who has held KLA for the long term, I should point this out. That $1.05 EPS figure probably made you do a double take.
Oh yeah, for sure.
Obviously, KLA used to trade at a massive share price with corresponding double-digit earnings per share. But effective June 11th, 2026, management executed a 10-for-1 stock split.
Right, and it's essential to factor that into any historical modeling you're doing on this ticker. All the current and prior per share amounts discussed on this call have been retroactively adjusted to reflect that 10-to-1 ratio.
Yeah. What's fascinating about this split to me isn't the fundamental valuation, obviously. Slicing a pizza into 10 pieces instead of just one doesn't change the total size of the company.
Right, enterprise value is exactly the same.
But structurally, it fundamentally alters the liquidity dynamics, especially for the retail investor base.
Oh, absolutely.
When KLA was trading at nearly $1,000 a share, executing standard options strategies, like selling covered calls, required nearly $100,000 of collateral just to control a single contract of 100 shares.
Which prices most people out.
Exactly. By dropping the nominal share price down via this split, management has radically democratized the options chain.
It absolutely broadens the base. It allows for much more granular portfolio sizing.
Yeah.
I mean, if you're managing a self-directed portfolio and you want, say, a 3% allocation to semiconductor metrology, you can actually dial that in accurately now.
Right, without being forced to overweight the position just to buy a single share.
Exactly. And when management actively makes the stock more accessible to the retail market, they do so knowing they have an absolute fortress of a balance sheet to back it up.
So let's dig into that balance sheet, because the cash generation here is practically software-like, which is absurd for a company that manufactures massive physical machinery.
It's wild.
In the June quarter, they generated $906 million in operating cash flow, dropping down to a free cash flow of $817 million.
And if you look at their trailing 12 months, that equates to a free cash flow margin of 28%.
See, that is the metric that should make any investor sit up straight. A 28% free cash flow margin in heavy industrial manufacturing is just wild.
Unheard of, really.
For every dollar of revenue coming in the door, 28 cents drops straight into the corporate treasury as cold, hard, unrestricted cash. And they didn't just sit on it either.
No, they unleashed a massive capital return program this quarter, handing $876 million right back to the shareholders.
It was an aggressive, highly structured deployment. They allocated $571 million to share repurchases, actively retiring stock from the open market, and pushed out $305 million in dividends.
And if you zoom out to the trailing 12-month view, their total capital return hit $3.3 billion. They ended the quarter sitting on $4.9 billion in cash and marketable securities.
Wow.
It is, from a purely financial perspective, just a masterclass in capital allocation.
But here's the thing, and this brings us to pillar 2. Anyone can read a cash flow statement and see the money piling up. The real alpha is understanding the real-world mechanics driving that cash flow. So what's the story behind the numbers? Why is demand for these specific metrology tools completely divorcing itself from the broader macroeconomic cycles?
To answer that, you have to understand exactly what the AI infrastructure build-out actually requires at a physical level.
Okay, break that down for me.
Well, the narrative around AI is heavily focused on software and large language models, right?
Yeah.
But for KLA, AI is a tangible, brutally difficult physics problem.
Because of the hardware.
Exactly. The industry is currently attempting to manufacture logic chips and memory architectures that simply were not possible 5 years ago. It's an entirely new paradigm.
Let's talk about the memory side of that equation, actually, because it feels like the hidden engine of this boom. To run these massive AI models, you don't just need the GPUs, you need high bandwidth memory, or HBM.
Right.
Standard DRAM chips simply cannot feed data into an AI processor fast enough to keep it busy. The processor just ends up starving for data.
Exactly. And the solution to that data bottleneck is HBM. which essentially takes multiple individual memory chips, sometimes 8, 12, or even 16 layers deep, and stacks them directly on top of each other.
Like a skyscraper.
Right. They connect these layers vertically using microscopic copper pillars called through-silicon vias or TSVs. Imagine drilling thousands of microscopic elevator shafts straight down through a stack of skyscrapers to let data travel instantly up and down.
Okay, that sounds incredibly hard to build, which introduces a mind-bending level of manufacturing complexity. And that brings us to a phrase management used repeatedly on the call: process control intensity.
Yes.
This isn't just corporate jargon, right? It is the fundamental mathematical formula that dictates KLA's future revenue.
It really is. Process control intensity is the percentage of a fab's total capital expenditure that must be dedicated strictly to inspection and metrology tools.
Okay.
Historically, as chip architecture shrank, this intensity grew linearly. But with the transition to 3-nanometer logic and 3D stacked memory like HBM, that growth curve has literally gone exponential.
So walk me through the physics of that. Why is that intensity compounding so violently right now?
Let's use a visualization.
Yeah.
10 years ago, when chips were largely two-dimensional and featured wider nodes, you could think of a silicon wafer like a sprawling, low-density city grid.
Okay, I'm picturing it.
The roads and buildings were relatively wide. If a piece of microscopic debris fell onto the wafer, it was like a small rock falling into an empty parking lot.
So it's a localized defect, but it didn't shut down the whole city.
Exactly. You would lose a single chip on the wafer, but the overall yield remained totally acceptable.
Right, a localized failure that you could just toss in the bin, no big deal.
But today, at the bleeding edge of AI hardware, we have shrunk that entire city down by orders of magnitude, and we've built it vertically.
Wow.
So that exact same piece of microscopic dust is now proportionally the size of Godzilla.
Godzilla, wow.
Yeah. If it lands anywhere on that wafer, it instantly crushes a vital atomic level intersection. Furthermore, because we are stacking components like HBM, a defect on layer 4 doesn't just ruin layer 4.
Oh, it ruins the entire stack.
Exactly. It ruins the entire 12-layer stack. The financial penalty for a defect has just skyrocketed.
So to prevent these multi-thousand-dollar total failures, the foundries like TSMC, Samsung, Intel, they have no choice but to inspect the wafers obsessively.
Right. They can't just run the wafer through the lithography machines and check it at the end of the line anymore.
They have to pull it off the line and run it through a KLA metrology tool after almost every single major step.
That is exactly what process control intensity means in practice. It dictates that even if the global volume of total wafers manufactured stayed entirely flat, KLA's revenue would still explode upward.
Because they just need more machines per wafer.
Precisely. The sheer physics of manufacturing these specific AI chips demands a higher density of KLA tools per square foot of factory space, and those tools must be utilized more frequently. It is a structural, non-negotiable pipeline of cash into KLA's business model.
Which perfectly explains the most astonishing data point from this entire earnings transcript.
The advanced packaging numbers.
Yes. It has to do with the very end of the line. CEO Rick Wallace basically dropped a bombshell, noting that KLA's advanced packaging process control systems revenue is now modeling to hit $1.1 billion in calendar year 2026.
That figure is just staggering.
Wait, it's more than staggering. It represents 70% year-over-year growth.
Yeah.
The consensus estimates from analysts had that segment growing in the high 50% range, which was already highly aggressive. Printing a 70% growth rate means they aren't just riding a rising tide, they are actively devouring market share.
Absolutely.
Management explicitly stated this segment is growing roughly twice as fast as the broader advanced packaging market itself. They are dominating the space.
And, you really have to appreciate the strategic foresight that led to this moment. This $1.1 billion packaging revenue completely validates a highly debated acquisition KLA made back in 2019.
Oh, right.
7 years ago, they bought a company called Orbotech.
I remember the skepticism around that deal. Orbotech was heavily involved in printed circuit boards, PCBs. It seemed like KLA was stepping down the value chain, like moving away from the bleeding-edge silicon wafer and into the seemingly commoditized world of green circuit boards.
That was totally the conventional wisdom at the time. But KLA's management saw the physical limits of Moore's law approaching. They realized that you couldn't just keep shrinking the individual monolithic chip forever.
Because physics gets in the way.
Exactly. The laws of physics, specifically quantum tunneling and heat dissipation, were becoming insurmountable barriers. The only way the industry could continue to deliver exponential performance gains was to completely reinvent how the chips were packaged together.
Right. So if you can't make one giant, perfect super chip, you manufacture several smaller specialized chips like a logic core, some HBM memory, a specialized AI accelerator, and you stitch them all together on a complex silicon interposer so they function as a single unit.
This is what they call heterogeneous integration. Technologies like TSMC's CoOS, which is chip on wafer on substrate.
Right.
Suddenly, the package was no longer just a cheap plastic housing with some metal pins. The package itself became an incredibly dense, ultra-complex piece of silicon routing that required the exact same rigorous inspection standards as the chips themselves.
And the Orbotech acquisition gave KLA the precise foundational technology required to inspect these complex high-performance compute substrates.
Yes. They essentially bought the foundational IP for a market that wouldn't mature for another 5 years.
It's incredible.
And now, in 2026, as advanced packaging becomes the critical bottleneck for every AI chip on the planet, KLA is sitting there with a massive, entrenched $1.1 billion business growing at 70%. That is management executing a multi-year thesis flawlessly.
It really is. And the beauty of this equipment deployment is the recurring revenue tail it creates, right? Which brings us to the services division. This is the stabilizing anchor of KLA's entire financial model. In the June quarter, services delivered $820 million in revenue, up 17% year over year.
Let's break down the mechanics of this service revenue because it's so important. When KLA sells one of these electron beam metrology tools for tens of millions of dollars, they don't just ship it and say goodbye.
Far from it. These tools operate inside Class 10 clean rooms. They require constant calibration, algorithmic software updates, and physical maintenance to maintain their nanometer-level precision.
And KLA provides all of that through ongoing service contracts. And CFO Bren Higgins highlighted a crucial metric for the financial modelers out there. 80% of this service revenue is strictly contract-based.
That 80% figure is the holy grail for institutional investors. It completely smooths out the cyclicality of the hardware business. You don't have to guess if that 800 plus million is going to show up next quarter. It is contractually locked in.
Exactly.
And right now, these foundries are running their KLA tools at maximum absolute utilization. When an AI foundry is printing wafers 247, any downtime on an inspection tool brings the entire multi-billion-dollar fabrication line to a grinding halt.
They will happily pay KLA top-tier subscription premiums to guarantee uptime.
Absolutely.
Management even provided an updated long-term target model for this specific segment, projecting 13% to 15% annualized growth for services moving forward.
Nice.
And while they're currently operating at the lower end of that range, they explicitly expect the growth rate to accelerate over the next 12 months as the massive wave of new tools they ship this year exit their initial warranty periods and convert into high-margin service contracts.
Okay, I hear the bull case loud and clear. The top-line revenue is compounding, the process control intensity is a structural tailwind, the Orbotech packaging bet is a grand slam, and the services revenue provides a massive contractual safety net.
That was pretty good, right?
It does. But I have to push back here. I'm looking at the transcript, and this quarter was not a flawless victory. Let's talk about the gross margins.
Yeah. It's the obvious pressure point.
Despite the record revenue and the massive growth in high-margin software and services, KLA's gross margins experienced a headwind of over 100 basis points.
Right.
That is a full percentage point of profitability erased. The reason cited on the call was that KLA faced acute inflationary pressure, purchasing memory components for their own internal metrology hardware.
Yes, their own supply chain costs went up.
But wait, hang on. If KLA truly possesses this impenetrable monopolistic moat and customer demand is so off the charts that they are capacity constrained, why on earth did their gross margins drop?
That's a fair question.
If they have the ultimate pricing power, why didn't they just instantly pass the cost of those inflated memory components directly onto TSMC and Intel? Why is KLA eating the margin hit?
That is the exact question multiple analysts hammered management with during the Q&A. And to understand the answer, you have to completely discard the software as a service pricing mindset.
Okay.
KLA cannot just push a button and raise subscription prices by 10% overnight. They operate in the realities of deep industrial supply chains.
So walk me through the timeline of a typical KLA purchase order. How does it actually work?
KLA operates on incredibly long lead times. Currently, the blended average lead time across the company is around 12 months. But for their most advanced complex metrology systems, the lead times stretch out to 18, sometimes even 24 months.
2 years. You order a machine today and it arrives in 2028.
Exactly. Now, when a foundry signs that purchase order today, the final price is locked in via contract. Fast forward 12 months into the build process, suddenly the broader semiconductor market tightens up. The cost of the specialized memory chips, the exact chips KLA requires to build the massive internal computers that process the terabytes of visual data. Their microscopes collect spikes aggressively.
Oh, I see.
KLA is forced to buy those components at a premium to finish building the tool. But they cannot legally, or practically, go back to a Tier 1 customer who signed a contract a year ago and demand a retroactive 10% price hike.
So it's a trailing indicator. The margin compression we are seeing in this quarter's financials is essentially the ghost of pricing agreements that were signed back in 2024 or 2025, crashing into the supply chain realities of 2026.
Precisely. As CEO Rick Wallace pointed out, attempting to unilaterally change prices on a signed backlog order would permanently fracture customer trust at the highest levels. So in the short term, KLA acts as the shock absorber.
They eat the localized inflation.
Right, which manifests as that 100-plus basis point drag on the gross margin.
But that doesn't mean their pricing power is a myth. It just means it operates on a significant lag. When KLA eventually rolls out a next-generation tool or introduces a major software capability upgrade that improves the foundry's yield, that is the moment they reset the pricing baseline.
Bingo.
They adjust the new sticker price to reflect both the immense value of the upgraded tool and the new, higher underlying cost structure of the components.
Exactly. The inflation is always passed on eventually. It just requires a product refresh cycle to bleed through the income statement. And crucially, CFO Bren Higgins noted that they expect this specific memory pricing pressure to normalize as we cross into next year, transitioning this from a margin headwind back into a tailwind.
Which makes the forward-looking guidance incredibly compelling. Let's pivot to Pillar 3, management guidance. We're moving from that temporary margin squeeze to where management expects the financials to go next quarter. For the September 2026 quarter, they are projecting revenue of $4 billion. Plus or minus $200 million.
I mean, they just printed a record $3.66 billion, and they are immediately forecasting nearly $350 million sequential jump. The acceleration is palpable.
It really is. And the profitability is scaling right alongside it. They expect non-GAAP EPS to jump to $1.16 plus or minus 10 cents. And, addressing our exact conversation about the margin squeeze, they explicitly guided for gross margins to tick back up slightly to 62.5%.
So they are already beginning to outrun the supply chain inflation.
Exactly. But what I find most revealing is exactly who is driving this $4 billion quarter.
Yeah, management was very transparent with the customer mix for their core semiconductor process control systems. They are modeling 73% of that revenue to originate from foundry and logic customers, and they're aiming 27% from memory customers.
Now, the 73% from logic makes perfect sense. That is TSMC, Intel, and Samsung pouring billions into their 3-nanometer and 2-nanometer fabrication facilities to crank out AI processors.
Right, totally expected.
But the real insight is buried inside that 27% memory allocation. Within that memory segment, management noted that a staggering 90% is driven strictly by DRAM, leaving only 10% for NAND.
And that massive divergence between DRAM and NAND tells you everything you need to know about the current state of the market.
Let's expand on that. Why is DRAM demanding such a disproportionate share of KLA's metrology equipment right now compared to NAND?
It directly correlates back to our earlier discussion about high bandwidth memory. HBM is constructed entirely out of specialized DRAM.
Oh, right.
Because the AI supercycle demands an oceanic volume of HBM, memory manufacturers are aggressively retooling existing lines and breaking ground on new greenfield facilities strictly to produce DRAM.
And because HBM requires that vertical stacking in those microscopic through silicon vias, its process control intensity rivals that of the most advanced logic chips.
Exactly. It demands intense continuous inspection.
Whereas NAND, which is primarily used for bulk storage, like the solid-state drives in servers and laptops, is a completely different architectural beast.
Right. You are still stacking layers, but you don't need the exact same logic-level precision and speed required to feed an AI GPU.
So the NAND market is vital, but it isn't experiencing the acute, AI-driven, supply-constrained frenzy that is currently supercharging DRAM capital expenditures.
Exactly. So KLA's revenue mix is perfectly indexed to the exact pressure points of the global hardware build-out. And this localized strength is what gave management the confidence to officially upgrade their view of the entire global macro environment.
Yes, the wafer fabrication equipment, or WFE, upgrade. This is the macro compass for the entire industry, right?
WFE represents the total global pool of capital spent on all the machines required to build microchips. It is the absolute total addressable market for KLA, Applied Materials, ASML, and everyone else in the space.
And earlier in the year, KLA's internal modeling projected the calendar year 2026 WFE market to land in the $140 billion plus range. But on this call, they definitively raised that floor, stating they now expect 2026 WFE to land in the low $150 billion range.
They upgraded the total market size by roughly $10 billion in a matter of months.
That is the clearest evidence possible that global foundries are pulling their capital expenditures forward. They aren't delaying projects, they are accelerating them.
Oh, absolutely.
And this momentum isn't capping out in December. The Q&A session featured relentless questioning from analysts trying to pin management down on their expectations for 2027.
And while management obviously wouldn't give specific 2027 revenue guidance this early, CFO Bren Higgins confirmed they are actively planning for, quote, significant growth next year.
When a conservative semiconductor CFO uses the word significant, you have to read between the lines.
You really do.
Right now, Wall Street consensus is modeling the 2027 WFE market to expand to roughly $190 billion. To put that in perspective, the market sat at roughly $120 billion in 2025.
Wow.
Moving from $120 billion to $150 billion and then to $190 billion in a 2-year window is a vertical, unprecedented expansion of industrial capital.
It's a true supercycle. Higgins explicitly noted that they are structurally preparing KLA to handle the most bullish 2027 scenarios imaginable. They're actively expanding their own physical footprint, locking in long-term supplier agreements, and hiring talent specifically to handle a surge of greenfield fab constructions.
New factories.
Yes. We are moving out of the phase where foundries just upgrade their existing tools. We are entering a phase where entirely new factories are being built from the dirt up across the United States, Europe, and Asia.
So we have a rapidly expanding total addressable market, a highly visible contractual revenue floor via the services division, and a structurally guaranteed increase in tool utilization driven by the physics of AI chip complexity. That brings us to pillar 4, the ultimate question for you, the investor listening to this analysis. What is the actual bottom line signal for this stock?
Well, based on the fundamental dynamics discussed on this call, the signal is aggressively bullish.
I completely agree. However, declaring a bullish stance on an expanding market is easy. The real test of an investment thesis is whether the company can defend its margins against the inevitable wave of competition that $190 billion market attracts. During the Q&A, an analyst probed exactly this vulnerability, asking a highly pointed question about the threat of Chinese domestic competition.
It is the existential question for Western semiconductor equipment manufacturers right now. The Chinese government is deploying hundreds of billions of dollars to build a completely self-sufficient, closed-loop domestic semiconductor ecosystem in order to bypass Western export controls.
Right, and the market fear is that with limitless state backing, Chinese firms will eventually reverse engineer their own versions of KLA's equipment and destroy their market share in the region.
But CEO Rick Wallace didn't dodge the question at all. He systematically dismantled the premise. He explained why KLA's competitive moat cannot simply be breached with infinite capital.
It comes down to the fundamental nature of the metrology business. He described process control as a strictly high-mix, low-volume market. Expand on that dynamic because it is the core of KLA's defense.
Okay, so if you are building standard deposition tools, you are stamping out hundreds of identical machines that perform a standardized mechanical function.
Right.
Process control is entirely different. Every single foundry's manufacturing process has its own unique physical quirks. Every time TSMC or Intel transitions to a new node, it introduces bizarre, unforeseen defect signatures.
So to win in the metrology space, you cannot simply build a camera or an electron beam that can see incredibly small things.
Hardware is only half the equation.
The real moat is the algorithmic integration.
Exactly. You need highly specialized proprietary software capable of processing terabytes of visual data in real time to separate random background noise from a critical yield-killing defect.
And KLA's algorithms have been trained on essentially every leading-edge wafer manufactured globally over the past 2 decades.
Right. You cannot replicate a 20-year proprietary data moat just by throwing state-backed subsidies at a startup. KLA software practically knows what a defect looks like before it even happens.
It fundamentally operates as a highly specialized AI company masquerading as a hardware manufacturer.
Completely. And more importantly, this software requires intense collaborative engagement on the factory floor. Wallace highlighted that KLA has over 1,600 applications engineers permanently deployed worldwide.
1,600? Wow.
Yeah, these engineers sit side by side with the customer's engineers inside the clean rooms of TSMC, Samsung, and Intel, actively solving atomic-level physics problems in real time.
A competitor cannot simply drop a reverse-engineered inspection machine into a fab and expect it to work.
No, without that army of embedded applications engineers seamlessly integrating the tool into the fab's proprietary workflow, the machine is useless. Wallace noted that because of this structural advantage, KLA is currently operating at a scale 6 times larger than its nearest process control competitor.
6 times larger. In an industry where scale dictates the R&D budget, that lead is practically insurmountable. Wallace concluded his answer with a definitive statement. When it is a fair fight, meaning KLA is legally permitted to compete and isn't handcuffed by specific geopolitical export controls on legacy nodes, KLA wins the business. Period.
And that leads directly to the core actionable takeaway for anyone trying to position their portfolio around the AI revolution. Right now, retail and institutional investors alike are tearing their hair out trying to pick the ultimate winner of the foundry wars.
Right. Is Intel going to successfully execute their historic turnaround with the 18A node? Will Samsung's foundry business finally resolve their yield issues and capture Tier 1 customers? Will TSMC maintain their absolute unassailable monopoly over the bleeding edge?
It's a massive gamble. If you bet heavily on a specific manufacturer and they stumble on a single node transition, your portfolio gets entirely wiped out.
But KLA offers a completely orthogonal approach to the trade. You do not have to guess which foundry wins the fabrication war. KLA is the toll booth on the only highway leading to the AI era. Exactly. As long as the global economy demands more complex, higher-performing silicon, and as sovereign nations force the diversification of supply chains away from Taiwan to the US and Europe, KLA's inspection equipment is absolutely mandatory.
They are completely agnostic to the logo stamped on the final chip. Whether that GPU rolls off an Intel line in Ohio or a TSMC line in Arizona, a KLA metrology tool had to mathematically verify its existence.
They profit purely from the escalating complexity of physics itself. The harder a chip is to manufacture, the more capital KLA extracts from the system.
They are a structural monopoly occupying a vital bottleneck in what is arguably the most critical industrial expansion of the 21st century.
And that is exactly why we walk away from this Q4 2026 earnings call with a resoundingly bullish outlook. We set out today to pull apart the financials and extract the reality beneath the AI hype. What we found is a company generating 28% free cash flow margins, maintaining a fortress balance sheet, offering a newly accessible entry point via the 10-for-1 split, and holding an unbreakable grip on the infrastructure required to build the future.
It really is the ultimate pick and shovel play. You don't need to bet on which gold miner strikes the largest vein. You simply own the company, selling them the highly calibrated monopolistic shovels they literally cannot dig without.
Spot on.
But before we close out this analysis, I want to leave you with one final, incredibly provocative detail that was buried at the very end of the Q&A session.
Oh, lay it on me.
We spent a lot of time discussing the WFE market expanding to $190 billion in 2027. Right?
Right.
But in response to an analyst's question about long-term capacity planning, KLA's management revealed that they're currently sitting down with their optical component suppliers to secure locked-in manufacturing capacity for the year 2029.
Wait, 2029. They are actively negotiating and locking in physical supply chain contracts 3 full years in advance.
Yes, because internally, KLA is actively modeling and preparing for a macroeconomic scenario where the total global semiconductor equipment market reaches a staggering $300 billion by the end of the decade.
$300 billion spent entirely on the equipment inside the factories. The sheer scale of that number is almost impossible to comprehend.
It is. And it forces you to ask a profound question that extends far beyond corporate margins and stock charts. If the semiconductor equipment market truly balloons to $300 billion a year, meaning the actual factories housing these tools will cost trillions of dollars to build and operate globally, how will that massive, unprecedented shift of capital physically reshape the world?
Exactly. How does a trillion-dollar redirection of global resources impact local economies? How does it strain global power grids and water supplies to their absolute breaking point? We started this conversation talking about how KLA hunts for a rogue speck of dust inside a microscopic clean room, but the reality is the shockwaves generated by this specific industry are actively terraforming the physical, economic, and geopolitical landscape of the entire planet. Something for you to ponder as you review your portfolio allocations. Thanks for joining us on this deep dive, and we'll see you next time.